Hi everyone, this is Karsha with the Boutique Accounting, operators of the Cash Lab. So I just want to talk today a little bit about your loan terms, the details of your loan. Do you know your loan terms? Do you know what your interest rate is? Do you know the term of the loan? Do you know how the interest rate is going to be calculated? Do you know if there are any changes that you can explore with the terms of your loan? So from time to time, business owners will take loans for various reasons, right? Might be to purchase additional equipment, a cash injection, for whatever reason. And just a word of caution, before you take that loan, ensure that it's justifiable and there's no other way, because at times might get a little bit tricky in terms of what the loan actually costs you. So you might be taking out a loan for $100,000, but in the end you're paying back over $200,000, which is a real cost to you, right? So there are a lot of things to think about with that. Will you have the revenue to subsidize that, to cover it? Is it worth that investment? Now, you've decided to take a loan. What are some of the things you need to be clear on and knowledgeable about? One, the loan terms. How long is this loan going to be? Is it going to be for 3, 4, 5 years? Another thing, what are the interest rates? Is the interest rate going to be a fixed rate? Is it going to be a variable rate, meaning that it's going to change from time to time? Probably every year they're going to review the loan, and the loan terms, and then the interest rate is going to be changed. Another thing to bear in mind is that interest rates are usually quoted per annum, per year. So if you have an interest rate, for example, say 12%, 10%, that means that that's what you're going to be charged for the year. There are times when it might be per month, but usually the banks or the financial institution will specify that. How is the interest going to be calculated? Is it a simple interest, meaning a set amount every month, or is it going to be compounded, which can be different? Is it going to be reducing balance method, which is as your principal goes down, then the interest which you pay will differ? So these are some of the things to be familiar with. A key document that is worth looking at is what's called the amortization schedule of the loan, or the details of the loan. So it outlines each month what you're going to pay for principal, what you're going to pay for interest. It actually breaks down the payment. So if you're paying $10,000 per month, what amount of that is going to your principal and what amount is going to interest, right? And any other fees which the bank or the financial institution might be charging you. So bear those in mind when you're thinking about a loan, and look at the overall cost of loan. What is it going to cost you? Another thing which is worthwhile thinking about also is this loan, can you renegotiate the terms on the anniversary of the loan, or can you go back into your financial institution and say, okay, I'd like to review the loan terms. Can I get a different interest rate? Can I pay at a shorter time? Are there any penalties that I might be exposed to or have to pay if I'm changing the loan terms? So all these things are areas that you need to be knowledgeable about as you decide to take a loan, and discussions that you need to have with your financial institution. So if you have any questions or comments, please let me know. Thank you.